The alchemy of finance is a concept that refers to the art of turning investments into profits. It's more than just buying low and selling high. It involves understanding market trends, predicting economic shifts, and making calculated risks. Hello viewers and welcome to our channel. In this video, we explore the captivating insights shared in George Soros' influential book, The Alchemy of Finance. Who is George Soros? George Soros, a Jewish Hungarian, was born on August 12, 1930. Known as one of the most profitable and powerful investors in the entire world, Soros has influenced millions of investors today. He also serves as the chairman at the Soros Fund Management, but is most famous for being one of the 30 richest people in the entire world. Thanks to his ingenuity, Soros was known to move markets when he gained recognition while competing against the British pound. The Alchemy of Finance, an overview. George Soros, a renowned investor and author, published The Alchemy of Finance in 1987. The book explores Soros' unique investment philosophy and his understanding of the financial markets through a combination of theoretical analysis, personal anecdotes, and real-world examples. Soros provides readers with a deeper understanding of his approach to financial markets and the concepts he developed throughout his successful career. Summary of The Alchemy of Finance by George Soros. In The Alchemy of Finance, Soros emphasizes the importance of reflexivity in financial markets. He argues that the traditional view of markets being efficient and reflecting all available information is flawed. According to Soros, market participants' biases and imperfect understanding of reality create a feedback loop between market prices and participants' beliefs. This feedback loop, known as reflexivity, influences market conditions and can lead to feedback bubbles or crashes. Reflexivity, understanding the market feedback loop. Soros explains that reflexivity operates in two distinct directions: the cognitive and the manipulative. The cognitive aspect refers to participants' imperfect understanding of the market, leading to biased perceptions and actions. The manipulative aspect arises from market participants' attempts to influence market conditions for personal gain. Understanding the interplay between cognitive and manipulative reflexivity is crucial for investors. The role of open society in financial markets. Soros emphasizes the importance of open societies in facilitating efficient financial markets. He argues that closed societies, characterized by authoritarian regimes and restricted information flows, hinder economic development and distort market dynamics. In contrast, open societies with transparent institutions and free exchange of ideas foster innovation, improve decision-making, and lead to more accurate market valuations. The reflexivity cycle. Boom and bust. Soros introduces the concept of the reflexivity cycle, which describes the self-reinforcing nature of market trends. In a boom phase, positive feedback loops create an overextension of market conditions, leading to an asset bubble. As market participants perceive rising prices, they develop optimistic expectations, further driving prices upward. However, these positive feedback loops are not sustainable indefinitely. Eventually, the boom phase gives way to a bust, as market conditions become overextended and participants' expectations are disappointed. Negative feedback loops start to dominate, resulting in a rapid decline in asset prices. Managing risk. Soros' investment approach. Soros proposes a two-step investment approach: understanding the prevailing biases and trends in the market, and developing a risk management strategy based on those insights. By recognizing the impact of reflexivity, investors can adjust their positions and portfolios to mitigate potential risks and capitalize on market opportunities. Soros believes in the importance of reflexivity not only in understanding market dynamics but also in shaping investment strategies. He acknowledges that market conditions are constantly evolving, and investors must adapt their strategies accordingly. The Alchemy of Finance explores various investment strategies that Soros developed throughout his career. He explains how he identified and exploited market inefficiencies to generate substantial returns. Soros emphasizes the significance of taking advantage of mispriced assets and market dislocations, which can result from cognitive and manipulative reflexivity. So this was our today's video. I hope you all like it. Don't forget to hit the like button and subscribe the channel. Thanks for watching.